How about bond-related investments? And this is really interesting. So if you look at over the short term, so this is short-term rates, so the 2-year treasury bond. So the 2-year treasury bond over the past 3 months has risen 171%. So it went from 0.32% to 0.86% today. So short-term rates went up a lot because they're anticipating the Federal Reserve increasing the Fed fund rate, and that's why the short end has gone up. A lot of investors bought short-term bonds because they were scared that long-term bonds were going to go up. So there was a tremendous amount of buying in the short end of the yield curve, right, which brought those prices up to levels you've seen. So if you own bonds 5 years or less, sell them because there's no value in those bonds today. Now, you may say to yourself, well, okay, the short end of the yield curve, right, has increased. Why hasn't the long end of the bond market increased? If you look over the last 3 months, the long end, actually the longest 30-year treasury bond is actually down 2.31%. And why would that be? So the bond market is a lot smarter than the stock market. The bond market either doesn't believe that inflation is going to be persistent, or they don't believe that the economy is going to continue to grow.